Hey Albert, how are
Hey,
you today?
Ryder. How are you doing, sir?
I don't know, man. I'm telling you, it's like you wake up in the morning. It's just I was saying it's just a box of chocolate. What's going to happen to the bond market? What's the news going to be for the day? And I just it's just crazy, right? So I was really hyped up about doing this purchase season. I still am, right? Kind of this, but we saw rates tending down. We're going great. And then, now oil prices are, skyrocketing and inflation, where it's kind of impacting the bond market, and that kind of reversed. It's like, but then again, next week it could go all back downward and we could be favorable. I just think the volatility is crazy, right? It just, just wake up in the morning, don't even know what rates are going to be. And I think that's impacting our market a little bit, right? We saw, when you look at the news the last, few months, it's like cancellations are up, right? When you have volatility, I think it's human nature, just like I'm just going to hold off and do nothing, right? I think that's just it. Wait till it settles down. So I think our market needs to be get back to more predictable, more consistent market. I think once we get there, and I'm hoping our market gets that way, and we'll see over the next few weeks how that goes, right?
Right. Yeah, definitely. I agree with you. It's, from day to day, as I have several friends in the industry and they all talk about it, we all initially thought that the rates were going to go in a specific direction. And then it's like, what's happening? It's like, this is doing complete
I
opposite of what we always known that would happen in these types of situations. So I don't know.
Yeah, it is. It's very unique, right?
I
So.
guess if we could figure it out, we'd be in a different business line, a
Yeah.
different line of work, right?
Yeah, if we had the prediction down, we kind of knew what was going to happen. We'd be on the beach, right, in Maui or something.
Right?
That's not me, right? So we grind it out every day, just like everybody else on the call, and
Exactly,
I
exactly. And
appreciate
it's
it, right?
always, hey, thank you everyone for attending another webinar here with us. So, hey, weather's heating up, so things are changing. Things are, this is generally what we know to start being the beginning of the purchase season. So, with that, we wanted to get you ready. We wanted to share some insights with you on certain things that we have available for you here at Home Express. So, welcome. Glad to have you guys here with us at this for this webinar. So, as always, we want to thank you for your participation. With us today, we have Mr. David Greider, who is our Vice President of Sales. My name, Albert Martinez, and I am your corporate trainer here at Home Express. And our guest speaker for this month is Nick Harvey, who is one of our regional sales managers out of our Santa Ana office. So, with that, Mr. Greider, I hand it off to you, sir.
Oh, gee, thanks, Albert, and thanks everybody for attending. It's like I can't appreciate our partners out there and in this field as we're dealing with the last few years. And the one thing I do about the market, because I've seen a lot of cycles, been a lot of times, there's always a need for families to find a new home for their kids as they grow, maybe move to different areas as they transcend and just deal with life and refinance. So even though we're in kind of a downtrend, but let's just see kind of what the mortgage market is going to look like going forward. So with that, let's kind of look at the agenda we have today, Albert, and we'll try to keep this to 15, 20 minutes. Please ask any question that you want. It could be on my impression of the market today, going to the future. It could be on scenarios. Anything you want, please put that in the chat and we'll answer those at the end. But we're going to talk a little bit Home Express for those that don't know about a company. Very brief. We're going to go into some trends and some forecasts. So we're kind of be up to date on what's out there. Even though some things might have changed from the data from a few weeks ago. Then go to some non-QM programs that we have, maybe some distinctions, right? If you look at today, non-QM is out there, right? Almost every wholesale lender does it, and they come up with DSCR or bank statements for self-employed. We want to give you something maybe unique. What differentiates us, right? So we'll talk a little bit about that, maybe to help you close more loans, and that's our goal. That's Nick and our my goal this year is to help all our partners increase their volume 20% this year, and so finding ways that we can help do that and partner with you on that in 2026.
Mr. Greider, before we move forward, I know how you like those polls. We always want to ask a little something from the masses, right? So that being said, we talking about the weather heating up. It being March, guess what's coming? Opening day.
Oh,
So we're
football season. Not football
Baseball
season?
season, sir. No, 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 no. That would be a kickoff. So here we go. So let's ask the masses. So with MLB Day happening at the end of this month, who do you think is most likely to win the World Series in 2026? Do you think it would be the Dodgers again, repeating? Do we think it might be the Yankees? I mean, they're perennial, right? They're always a old school team to be in the World Series, right? Do we think it might be the Blue Jays that were really hot, last season, or would it be the Mariners taking another stab at it? What do you think, Mr. Grider? What say you? I know
Oh,
you're a big
I'm
Scouts
gonna go with the
fan.
Mariners because I don't know much about baseball, but since the Seahawks won the Super Bowl, let's go with the Mariners. I like somebody put on here, go
Go
Brewers. It could
Brewers.
be the Brewers. I don't know enough. I mean, this is Albert's domain, and he loves the Dodgers. So,
I
Albert,
yeah, I checked it out with ESPN, and ESPN, these were the top four teams that all the analysts think are the hot team. But hey, just like we talked about the market, right? Like, who knows? We definitely
nah,
don't.
I don't know. It's
All
kind of
right,
like the bond market. Who knows?
who knows? Here we go. So the masses think the Dodgers are gonna win it again. They do have a really good team again. It's a hot team.
I
So
think they spend the money. They bought the players. Come on.
I mean, just Otani alone. I mean, go figure. But with that,
Yeah.
Mr. Ryder, back to you.
Great. Well, thank you. Well, here's your agenda. Let's kind of dive into a little bit about Home Express, and I always put on here where to find us, right? So, of course, we have our X Connect portal where you can get pricing at. Um, but we wanted to develop all the pricing engines that we tailor to you and how you price your loan. So, these are all the things we're on, as far as Loan Sifter, Poly, Loan X, Lender Price, and newly is arrived. So. Sometimes you need to have your admin with Loan Sifter click the box so Home Express pricing shows up. Um, then that needs to be done. But I just want to know we're really trying to be a good partner with you, so you don't may have to get out of your LOS system or your normal pricing engine to find us. So with that, we'll go to the next slide and get into some of the housing trends that we see today. I know nobody can read this, right? But everybody that's registered on here is going to get a copy of the deck. I thought it'd be good to know. This is from MBA from February, and really we're trying to look at the volume in the purchase area from 25 into 26, see what areas those are in and the trends are there to help you kind of figure out where you're going to market for some of these loans. So I kind of blew it up on the next slide to kind of look at, hey, what quarter by quarter is different from 25 going into 26. So I will go to the next slide and kind of look at that. Here we go. Q1. And I'm telling you, Q1's been a good year in 26 on volume for us, right? Every January is the best January we had. February was the best February we have. March is looking strong as well. And a kind of indicative, here's the chart, right? So 26 volume, more than 332 billion is predicted. Last year was 272 billion. That's pretty significant increase. And then we're seeing it as we go through Q2. Q3 and Q4, right? Some of the key projections I put on here, just existing home sales growth. Yep, there's predicted go up. Sales volume a little bit. New home sales going up 5%. Inventory levels that are active, that's going to see that increase as well. So everybody, though, is expecting rates to stay flat in the 6.5 range. And so I think that as we get into kind of interpretation of where the market is and where the clients are at, that can be probably based on affordability as we go through this. So let's go to the next slide and kind of look at some markets trends here. What this is, the housing inventory level had a dip in January. And if you remember, some of the articles was like, and I've seen it on the news, is all the delistings, right? So we had a whole bunch of homes listed, delisted off. I think those are going to come back on the market, might be more realistic price point from what they need as we're going into the next couple months. But we have a trend where there's more inventory out there for potential buyers. And I think that trend will continue in 26. Everybody's kind of I think, used to the norm. Rates are going to be 6 to 6.5%. Right, and they're going to have to move, right? Of just realizing that, So if they want to downsize, they're going to do that. They're going to move to other areas for employment. Their family goes into other areas. That is going to happen. I think everybody's going to kind of say, hey, this is what it is. Let's look at the next chart here we have. I always put this on the beginning of the year of two different segments. What's the top segment where population is moving from and moving to? Because both of these are going to have activity. So if I'm in a state, let's say California, and that population is moving out, they need to sell their house. Someone needs to get a mortgage on that house. All those type of things that happen as population trends. Likewise, where are they moving to? Let's go to that area. So kind of look those up. I just put on here some of the states that are having the decline of population moving from and moving to. Moving to looks like Midwest, still some of the Southeast, even seems Salt Lake City up there, right? So you just kind of look at those areas if you're in those areas, whether it's consumer purpose or the investor programs that are out there. These are some areas to look at. On the next slide, we're going to go so some of the interesting trends. I just call it interesting, right? Is this gap between home buyers in the market versus sellers. A pretty big gap, right? So everybody says, "Hey, we need inventory levels are low." I actually agree with that to this perspective of homes out there. There is a real lack of affordable homes. That's what it is. I think they'd have a lot more buyers if it was more affordable, and we need to get to equilibrium. But kind of understand that there's more sellers than there are potential buyers, and I think it has really to do with two things. One is affordability. The other one is the volatility and the human trend is if it's volatile, I don't know where the markets are going. I mean, we got oil prices going up. They do nothing, right? I'll wait till it goes in. So I'm hoping the market gets to more stable, predictable of, hey, this is the trend it's going to be. And then I think we'll see some more entrances into the home buyers. The next slide, Albert, is just kind of what I'm thinking, and I've read a lot. If everybody knows me, I'm kind of one of those guys that looks at a lot of data, right? So to kind of figure out what it is. So this is just my opinion is that affordability is still going to be an issue going forward. It just is, right? It's too big of a gap. We need wages to go up, or the home prices, or at least the payments in total to get to affordability area. I do think this year is going to be improved over 25 in the purchase market, right? The refinance market, I actually think is going to improve as well. And that is really the realization of maybe I've been waiting to refinance. They put on some other consumer debt, say I don't want to do that. There's going to be a point where if they save $800, $1,000 a month, that's probably better for them financially. It's given up the 4.5 going to 6% for that monthly savings for their family. The investor market, I think, the return on investment on fix and flip has been challenging in whole across the country, but there are pockets where it still makes sense. I think you're going to see that. I think you're going to see some smart investors still pull cash out and look at trends as people are selling some of these areas where they have good cash flow, right? And we need to partner with them. Okay, now we're going to get into some programs, and this is kind of at a high level. Then we're going to get into some differentiation to us of why, what value do we add to you? And I always say that we got wide variety of programs. We're transparent. It's predictable. You can send us a loan. You kind of know what it is, and it's going to close. And you always have someone to talk to on that. And plus, our AEs are fantastic at structuring any loan you have. So I'm going to let Nick talk a little bit about our consumer purpose, and it's mainly self-employed, but it could be some other credit events and our business purpose, Nick. So tell us a little about the consumer purpose programs.
Yeah, thanks, Dave. These are two great programs going into peak season of purchase season, right? I mean, bank statements, self-employed borrowers, real estate investors, borrowers that need those, high LTV jumbo loans, right? DSCR and bank statements are great for those borrowers. Self-employed borrowers up to 90% on our bank statement deals. We can do a 1-year cash flow program if someone's been recently in the same line of work and went out and has 12 months of self-employment. We can help them there too. Asset-based programs like Asset Express is the one that we're using here. Those are great for those borrowers. Again, non-traditional income and credit challenges, right? The Asset Express program, you can utilize seasoned assets over a 60 month period to get extra income to help qualify. So you might be able to use bank statements and then have a bolt-on to that income figure with using an asset program. DSCRs, we will go up to 80% on our cash outs as well. That's a little nichey for us. Other competitors aren't going that high, but those are great. Long-term, short-term rentals, we can do all those. And then you want to talk about how you can educate your referral partners, right? On other programs that are not just the bank statements and the DSCR. And that's where you could talk about the asset program, again, said that, or even net rents, so form a full doc where we can utilize the lease agreements on a property to net out the mortgage payments, and you don't have a gross back end debt, which can really flip your DTI around. That's another thing that maybe we could all focus on.
Yeah, no, thanks, Nick. And I talked to a lot of people in the industry, and the biggest factor you have in the agency or government world is the income and DTI. And this is where you come into here, and we're going to go a little bit more in depth on some of those on the next slides of like trying to differentiate, say, hey, maybe it's something you didn't think about on what can be done, right? So Albert, let's kind of move on through this as we're going through. It's like streamlined guidelines, and I think that's important so you guys know. We try, we have the theme of speed, ease, and convenience, right? So we try to get these deals done and looked at, and sometimes the seller, we can go faster than the seller wants to close, the closing date, right? That's ideal, what you want to be done, but as I look at the market today, is you have a lot of people with second jobs that might be self-employed, gig works, and their W-2. We're good with that. We can use a W-2 with bank statements or whatever form, how they get paid, get that verification from that, from the cash flow of that gig work. Great. Good on those. You can do multiple streams of income that way with us too. Maybe they own several businesses. We can both businesses, we can look at the income on both of those. You can combine the W-2 with the self-employed. You can got this asset program Nick talked to you about, divide by 6. You can add it on to our income programs, right, to help that DTI there. So we have a lot more options. You kind of go through that, and you don't have to be an expert on this. This is a high level view. What you need to know is like who to call, and we have very responsive account executives are going to go through that loan with you and put that deal together so that gets, you can close more loans this year. So let's look at some other items here on the consumer purchase. I always talk about properties too. It's like, maybe Nick, you want to talk about some properties here? It's like, because we got a wide array of make sense deals, right? Where you might not think about it, like condos, right, Nick?
Yeah, a great investment property, or potentially even, a second home. Those are done predominantly in resort areas. We do not have a occupancy restriction as far as investor concentration. It could go up to 100% non-owner on those because we know that's what those properties are for. We have basically no minimum square footage. I mean, we would say 500. It's like sometimes studios we'd have to look at, but those ones are great. Let's see, on non-warrantable condos, same thing. Those are great. Sometimes people have some issues with those. We do those really well. And then short-term rentals are another good one that we can do. You just Airbnb, VRBO. We qualify off of 12 months average of the received income from the ledger from Airbnb or VRBO. So those are some other good ones, property types and stuff that we can do.
Yeah, I guess the thing is that we're a true lender. We underwrite to our guidelines and fund with our own money, and we can make exceptions for good deals, right? So I look at it as like, give us your scenarios. We want to look at those, and we can help you structure those to get in. We have a scenario desk even available that's in our credit department where they can say, hey, this is what I got. And we'll let you know kind of like what we've done that. So you're going to get an answer really quick on some things that might be unique. Other things that come out with reserves. I mean, shoot, sometimes 80% low, don't need those. Cash out reserves and credit events that, greater than a year, real flexible on some of those items where, hey, things happen in life, right? We all kind of know that to look at those. All right, let's take a look next at the business purpose. And lots of good things here. I think our clients really appreciate kind of the speed we put on here and the streamlined conditions. So, Nick, would you like to talk a little bit about our business purpose, maybe a little more detail on some that make market rents? Like we don't even need lease agreements, or we could use lease agreements if it's higher. All these type of things to help make your deals go through.
Yeah, yeah. Thanks again, Dave. ESCR, great program that we're doing. So market rents versus actual rents. We can use the actual rents to help qualify where sometimes it's a little bit higher than where market rents are. We don't have a variance to what that has to be where some of our competitors will. Long-term rentals, those are pretty easy. Like we just kind of mentioned short-term rentals a minute ago, where you can take the VRBO ledger, do a 12-month average in place of the lease agreements. You do need to have the AMC gives short-term rental comps. But again, those are great too with in resort areas or condo hotels like we went over as well. The cool thing about the business purpose program is that they're non-trid, right? So streamlining the process, making it, less conditions, quicker and faster to fund. It's the Section 35 exemption for business purpose loans is to acquire, maintain, and improve. So it's not necessarily how a borrower will qualify as far as maybe full doc or bank statements or DSCR. We can treat those all as business purpose. And in states that this map is showing here are states that do not require necessarily an MLS license. So you might be able to do a DSCR or a bank statement deal in the state you're not licensed and expand that market base, bring in more loans, and put more money in your pocket.
Awesome, Nick. Yeah, so lots of options for you, even DSCR below one's allowed, four nationals, closing an entity. We do everything in-house. That makes it easier. So our interview team's here, all these different things to help you close your loan quickly and really efficiently and predictably. All right, let's go and to look at some other programs that we have. Be in there. Is Prime Jumbo, right? Everyone knows that. Now, this is a full doc, but we use the AUS findings. There's no appraisal waiver on those, of course, but DTI can be higher, all those sort of things. Great pricing on that. It kind of fits into the non-QM model as well. We also have agency non-owner occupied. It's still like an AUS product. The things on the agency non-owner occupied, it is kind of agency product, but it's not the Fannie and Freddie. It is run like an AUS with a few overlays. Great pricing. The pricing is better on that than typically on a Fannie or Freddie pricing engine if it's a non-owner occupied that you're looking for. A little bit of caveats. So I just want to throw it out there. If you're pricing that, you could see this on those pricing engines. Okay. Let's go next, Albert. I don't know if you have another poll yet, or we're going to keep going. But I looked at this on this sheet. I want a sheet that I go out there on our loan sifter is we're primarily a non-QM company and always will be. But we've had through the years clients ask, well, how come you don't have some of the government programs or conventional programs? Oh, okay, great. We'll put that on there. Love to send you a deal. You're kind of easy to work with, those type of things. So since we're primarily non-QM, all we did is put a couple programs out here for you on the agency and government side and say, here it is, very low margins. And wanted to show you what it is, right? So this one is a $325,000 purchase in Texas. They targeted 102, the 102.50. Boom, right there. Number two on Loan Sifter, right? And it's just there, right? It's really vanilla loan. We don't do a lot of manual or anything of that nature. But if you need a deal to close, love to get your FHA and VA, which is on the next slide, to show what our VA pricing is. There you go. Here's just a target. Just going to throw it out there. We're actually, I think, number three on this one, a $500,000 purchase, target 102, right there. And you got great service. It's on these. We have a team. We got HUD underwriters in place. Be great, right? So it's a very low margin on our side, just for our partners on the wholesale side. Okay, we'll
Mr.
go to the next.
Tiger,
Yes.
before we keep going forward, we talked about rates, we've talked about programs, but I think that we should probably ask the masses what they think about the purchase market, right? So considering, rates and everything that is going on and affordability, what best describes your outlook for the 2026 purchase market? Strong rebound in demand. Do we have modest improvement? Is that what you think? No meaningful change, basically it'll stay flat, or I have no clue. I don't even know. I mean, this
Yeah.
seems to be the theme on a lot of things. Right? We don't know.
Maybe you could throw the dart at the dartboard with those and probably be just as accurate. Yeah, I think it's going to be modest improvement. I really do. Just modest improvement. I think. I mean, if you've been waiting a couple years to move to a category, downsize on that, they're just looking at the forecast on rates and the markets. I think they're going to make the moves.
I think you hit it on the nose, Mr. Grider. Look at that.
Oh,
Modest
look at that. I
improvement
did every once in a while I do okay.
every
So
once in a
that's
while.
my
Yes,
one
sir.
for the year, right?
You are correct, sir.
All right. Let's go to, ways to expand. And I guess we're trying to look at kind of give you some ideas. And our AEs actually help our partners. May put a webinar with your LOs of ways to find non-QM borrowers who are out there marketing for it. We know that's a segment going up. I just put a few on here for you. Always start with real estate agents on the purchase side. You got to get in with them. I mean, they're the main contact. If somebody is out there looking for a home or deciding to go purchase, they're going on the web and they've got to look at a listing. They got a real estate agent, right? Be there, let them know, hey, we have a full array of products, and we have the AE that can put a deal off if it doesn't quite fit through traditional financing, right? And the more you close from this, remember, rates are high. 5 years from now, I don't think they're going to be this high. I think right now it's this way. That's your next loan, right? That'll be a rate and term for that. And if you close some of these deals, I mean, self-employed people and investors know other that are in the same doing the same things. If you do a great job, you're going to get a referral. They're going to tell you that, and that will really help you grow in 2026. All right, let's go to the next slide, Albert. Here we go. There's some ideas on here, and if you want, maybe one of our AEs to contact you or your team there, please put that in the comments. We'll get that over to them, and they'd love to set something up for you on where to find some of these, right? I actually believe the real estate agent and the social media. I was talking to somebody maybe like a week ago, and believe it or not, for the social media and links they put out there, kind of branding themselves, they had somebody apply on the link, go through, buy the house, boom, and close with really not really even talking to them. It's kind of unusual, but you're gonna have there's people out there just like to get the deal done. They see you out there, the rates competitive, streamline the system, and went right through. And actually, the LO didn't have to talk to the potential borrower. It just went through. So a lot of things you can do to get your brand out there, and the ease of use on your system is great. But network financial planners. By the way, CPAs know a lot of self-employed borrowers, and if you have a self-employed borrower gets turned down from the bank, they usually call their CPA and say, "Hey, man, tax returns, you did such a great job on that, but here's the deal: I need a loan. You got anybody that you know of that can help me out get a loan that the tax returns don't work?" Yes, I do. I got the LO in mind. So kind of think of those things as you're going through this, especially this purchase season, where that might be a possibility where you get some referrals out of that. Next, we'll kind of go to the next slides. And this, we always try to put out some recently closed loans to make it real for you. And I'll have Nick talk a little about some of these recently closed loans to give you a couple examples as we kind of finish up here.
Yeah. So again, these go in great examples of the types of non-QM deals. So we had a purchase in California, it was 500K. The challenge was the borrower needed to use bank statements and didn't have total amount of their own down payment. Well, with ATR, we met that with 12 months bank statements, which we've been talking about, and we allow 100% gifts on an owner-occupied purchase with 20% down, 6 months reserves. So we're able to limit their payment shock and get that one done for them. Another similar one, if we got one more slide, is we had a purchase 600,000 in Nevada. It was an agency fallout due to DTI, and so the borrower had annuity and pension, but didn't have enough to cover. But they had a savings account, was pretty much a static account, had 900K in it. for liquid assets. So as we talked about earlier, we bolted on our Asset Express program where we're able to take that 900K divided over 60 months and add an extra 15,000 to qualify, had enough for reserves and obviously good FICO. So we were able to get that one done for them too.
Awesome.
I think we got one more. I think we got there.
Okay.
Yeah, purchase 1.6, California. It fell out from another lender because they were trying to do a 1 year full doc, but they had a servicing issue. Sometimes people get caught up in the transfer. Maybe they didn't get the goodbye letter, maybe they didn't get the hello letter, but they had a 60-day late and they weren't able to do it at other non-QM lenders or traditionally. But as we're a make sense lender, we looked at that and said, well, that's kind of a life event and it's an isolated event. We kind of know what happened. We're able to document it. We're able to give them 25% down with a 680 FICO and make that one work as well. So it's kind of thinking outside the box. It's you're running a 100-yard hurdle, and if you hit a couple hurdles, get back up, keep running. Talk to your LO or talk to your AE and see if there's another strategic way where you can make that income work for them.
Awesome. Absolutely, Nick. Thank you for that. Kind of wrapping up, I just wanted to let you know we do have the non-delegated correspondent channel, no carve outs on it. More flexibility, as you know, with some of the LO comp rules. So really good avenue if that's kind of your preference of being the lender and taking advantage of that. Just contact me if you like to learn a little bit more about that our non-delegated channel. Next, we'll kind of go through questions, Albert. Woo, we got through 30 minutes. This is great. Kind of where I target 25, 30 minutes. And put the contact there. Well, we got next webinar to be determined, right? It's like we'll put something on content. It's hard because we're going to put something on here and just the geopolitical stuff and everything going on. I think I might address that or come to say maybe we should address how do you lend in this environment? What do borrowers do? Why are they counseling, right? Maybe we can walk them through that. I don't know. I'm taking your advice, but here's my contact information, Albert. Let's get to some of the questions here.
Yes, sir. So we have a few. Jada wants to let us know that I focus solely on business purpose. So is there any way to make pricing more competitive? That's what Jada's asking.
Um, we are constantly looking at trying to be more competitive. I'll go like this. It's like everybody's trying. If you looked at the mortgage market, and there's a reason why the Rockets, UWMs, Kind Lending, all these other people are getting in. They just come into this market because the volume has really dropped on the agency production, right? And I get all that. So they might have trying to get entrance in there on that and trying to get that and trying to grow. We know we got to be competitive. And by the way, I'm in our pricing meetings trying to look at competitiveness on it as well. Reach out to their AE, see if there's something we can do on a particular loan, because there's things we can do as long as it's reasonable enough. We could probably match that. We'd love to take a look at that for you. And we do get that a little bit with us because they like our predictability, kind of know what we do. It comes in, we've been doing it 10 years. And we know non-QM, right? So it falls off the rails, we get it back on there for you pretty quickly. And we have a little bit more understanding of that particular market as a true lender in the non-QM. But great question. I put that down. I think we had like a little scare on Sunday this recently, right? So we backed down pricing a little bit to improve that yesterday. And we're going to go look at it again as well as we're going to the weekend. High volatility, I mean, what do? Right? It's like we're going to be here today, tomorrow, 5 years from now, and we need to make sure we're taking care of all the partners, our bond buyers of all these things, and so we're going to look at that, right?
Awesome. Thank you for that, Mr. Greider. The next question is from Andrea. She asks, hello, any chance you'd consider yield spread program to stay competitive with other lenders?
Yield spread program. And this, I'm looking at this from maybe the DSCR, because on a consumer purpose, you're regulated, right? So on a consumer purpose, either, especially on the wholesale channel, you're either going borrower paid or lender paid, right? That's it. It's kind of set. When you go into the business purpose, we do allow yield spread premium. Maybe you weren't aware of that. Yes, we do. If you don't have an AE, kind of reach out to me or put a comment in here. We'll get reach out to you. That is available on the non-TRID loans on the business purpose. So we allow that variable compensation. This is for
Right.
DSCR loans. Absolutely. We have that available. You just need to be signed up for lender paid comp, and then that box will open up in the portal where you can get yield spread premium on that. And we put that out there because we know you need to be flexible. Maybe you can't charge much up front, but and you're trying to work it out for the best loan for your client. And sometimes you need that flexibility, and we have that available for you. Yes.
Definitely. And that is, Andrea, just to let you know, that is available in our portal once you sign up for the option to have variable YSP, right? For business purpose loans. When you price out the loans, you can, from loan to loan, you can change your compensation. And that way you have the complete latitude and flexibility to select how you want that pricing to be structured. So we definitely do offer that right now. Jada, more nuggets like that. And I think that comment was dropped as you were talking of where to find these buyers, right? Where to find investors, where
And we have webinars on this. And if you want a little more detail, reach out to your account executive, our regional sales rep like Nick. They'll have this and say, hey, let's just look at your community. Let's figure out a way to get more market share in that because we know it's growing.
So Danny writes, agreed on the CPA source, but some cause CPA friction when they refuse to with lender verification requirements. This stalls pipelines, wastes value productivity, and there's a solution. According to our 5-star reviews from AEs and brokers and processors and borrowers, we are a lender-friendly tax firm representing that CPA friction with topics. How about this as a topic?
I
Okay.
don't know. Okay. We'll take it down. Yeah,
Yeah.
absolutely. Right. Yeah, I don't know.
It says I sent questions in the Q&A section. Should I put them in the chat? I'll take care of those. I'll take care of the Q&A as well, Jada. What states are you seeing more investors in?
Yeah, that's a great question, right? Really are targeting certain areas, and I would say Midwest has kind of gone up, and I'll tell you why. That's where the cash flow is. So they're looking at kind of the Midwest area of, hey, I can get into $200,000 home, fix it up, and the cash flow it will work at the rates the mortgage are today. So really, they filter into areas where they can get a home, maybe put some money into it, 25, 50 grand, whatever that is, get it up to there, and then get the cash flow. So they're always looking at areas. So you got to look at where the average rents are going and the trends of that. So if you're going to areas where the trending of the rents are going down, and that's certain areas, rents are going down. You're looking for rents that are stable or kind of slightly going up, and then you look at the home prices and what the cash flow will be. You kind of do that cap rate, and most of these small medium investors understand a cap rate, even though it's not part of our equation on the DSCR to that extent. But they're actually looking at that, right? And what's that value of the home going to be 5 years from now? Those type of things. So if you go into the Midwest there, I think it is great. And by the way, even though there are a little bit smaller loan sizes on the DSCR, not as much competition. Everybody kind of goes for the big loans in California, just the coastlines, right? You see that, or resort areas in Colorado and those type of things. You still want to get those, right? I mean, I'm telling you, those are great purchase loans, especially second homes that we do a lot of, right? And the short-term rentals Nick talked about. But man, the Midwest, I'm telling you, not a lot of going there, and you could own certain markets of like, hey, we got some real estate investors, we got some real estate agents I'll connect with. And by the way, so a lot of these states don't even have to be licensed in NMLS status for those. You're good to go.
Thank you for that, Mr. Greider. I would probably add to that Jada, as you know, as a partner, and as one of our value adds that we have for you, our experienced account executives are able to actually help you and provide you to where to find more business. That is something that we like to pride ourselves on. As a partner to you, we like to show you other ways in which we can help you find business. So definitely connect with either with Mr. Greider, his information is right up here, or you may want to connect with your account executive as well. We'll be more than happy to go into more detail into your specific market and markets that you want to expand to. I do have another question here from Jada. It says, I want to start helping higher valued loans. I want to start helping higher valued loans. What markets are you seeing more of those?
Yeah, you're going to go to California. You're going to go to the coast mainly on that, right? So I'm just telling you, you go up and down the coast. That's where usually the higher value properties are at, right? Um, Sometimes the inner cities areas are not as high value. Kind of be careful of that, or they might be trended down. But you go to the coast and resort areas; those are at right. So that's the areas to go. We see a lot of them. California, Florida on the coast, right? As you go up that all the way up through Massachusetts area, right? So as you see, we don't quite lend in New York yet, but we're in 46 states, right? Alaska, Hawaii. We get a lot of big deals in Hawaii. And by the way, Hawaii, you don't have to be NMLS licensed in. And so there's lots of things as you kind of strategize for to go. But I agree, right? It'd be great to do a $2 million loan, at least one of those every month, right? But don't forget about the Midwest. That could be like, hey, that's my regular paycheck. If I get when I close one of these, every month or 2,000. That's my savings account. I'm going to build up. Don't know how the market's going to look the next couple of years. I think that's a pretty good strategy. You go into like Vail, Colorado, up in there, really great. But there's other resort areas too. Out of Idaho, people don't know. It's like some of the best places I've been to is I call it like a junior Lake Tahoe area, right? They have an Idaho up there at the lake, really nice, right? And so, kind of think out of the box. Where do people go in that community for second homes, those type of things? Second homes usually when those buyers are there, because everybody looks at, hey, the medium home price keeps going up. That's because there's more buyers on the higher valued homes, so it kind of drives that up. And so, those that have money still want to buy second homes in certain areas, whether it's on the coast in Florida, some of these nicer areas in the mountains so that they like that. Whether you're talking Lake Tahoe area or place in Idaho and mountain, still goes on today, right? And Hawaii as well. So that's a good strategy. Kind of figure out where your expertise can go in there, where you can build that expertise for those areas. Maybe the short-term rentals, because if they're in there as second homes, right? All right, and if they qualify that, bank statements, self-employed borrower, well, nothing preventing for the other 6 months not in there, right? To rent it out as short-term rental to offset that. A lot of them do that as well.
Awesome. Thank you for that. Andrea says this is for DSCR loans. Let's going back to yield spread, but doesn't it show as yield spread on the HUD?
I don't think it does, but I'm not saying I'm a compliance expert here at Home Express, so I'm not saying that. I don't think it does. I think it's just paid outside that. Again, it's
Yes,
not regulated. You don't have to, right? These are business purpose loans. They don't have the same regulation you have on consumer purpose. So I don't believe so. But
that is
we'll
correct.
get back to you on that.
That is correct. So Jada, I love Robert. Okay, so Robert must be her AE.
Martin
Would be
McDonald,
glad,
probably.
probably McDonald, probably Robert McDonald. Would be glad to chat with him on these kinds of tips. Perfect, great. We'd love to hear that. Are there any restrictions to rural areas? Joe is asking.
Yeah, here's how I kind of describe it. We do rural, but we don't do remote. Right. I think there's a clear definition of that where you kind of understand where when you're really remote, there's no, you know, hospital or any medical care nearby. You have to drive for 2 hours to get there. There's no shopping, there's no employment. And by the way, to get to the next house is another 25 miles. That's too remote. What we need is it could be rural. So when you're looking at it, it's just okay. It's out there in rural. A lot of people do that. Maybe you're an hour outside, you have a little more acreage or whatever the case may be. It's not a bigger populated area. Okay, we're good with those, right? Again, we're not doing the 80% on that. Rural is going to be a little cut back on value, right? So when you look at a property, I look at it from two ways, right? Um, is it marketable and is it legal? So anytime you get rural and you start going remote, the marketability gets curtailed a little bit because the population base doesn't really look for those. So the marketability is that. So that's why you curtail LTV. Then the legal is it legally able to have that type of property on that land. Okay, you match those and you can prove that, and there's probably on every loan a right LTV to work with. Doesn't say it doesn't always hit the securitization market. So if it doesn't hit that, then we can't do it. But that's kind of where I look at.
Awesome. Joel did add a little bit. He said, okay, cool. Thank you. What about commercial investors, apartment complexes, and business?
Yeah, we're in the residential sector, but here's a caveat. We do have a 5 to 8 DSCR. The guidelines are not like the 1 to 4 residential, so it's a little bit tighter box on the 5 to 8. But we're sticking primarily, at least right now, and what we've done historically into the residential sector. And the 5 to 8s can actually go in those as a small percentage of that pool. And so we allow that as well. And that should be on your list of pricing. But it's something to consider down the road, right? I mean, but we're going to stay the non-QM residential sector. That's going to be primarily what we do. Even though we have some great, and by the way, we get a lot of FHA and VA loans because of pricing. We want to help our partners with that are signed up with us and help provide the service on the non-QM and all the ways that they can grow their business this year.
Awesome. Danny is asking, do you accept IRS CTEC certification for bank statement verification letters and or P&Ls?
Bank statements, okay, this goes on two things. So, bank statements, the third party is the bank itself. So we don't ask for anything else on it generally, right? Not very rarely, but so we use the bank statements with a standard expense factor based on a questionnaire about the business. Look it up, you kind of know what it is. However, you go to the P&L sector, we're probably a little more conservative. If you do the P&L only, which we have two, P&L only and P&L Express. The P&L Express is just no bank statements at all. It's just a P&L. We do require a CPA. And we think that's a prudent way to go with it from the history of those portfolios over the last 5 years.
So thank you for that. And then Mark wants to know, since DSCR loans are non-QM, are you okay to do loans outside of states we are licensed in?
Yes, that's what I'm saying. We're okay with that as long as it's not a state that requires MLS. There's a few states that you have to. California is one of them, right? By the way, you have to be an MLS licensed to do DSCR. State of Washington, no. Texas, no. Florida, no. So we have that. We'll get together with your account executive. But yeah, you can do them outside of. There's 30 some states where you don't have to be NMLS licensed. And you go
Awesome.
outside your state that you're licensed in.
Yeah, and we do have a map available, which again at the end of the call, we'll make a copy of this presentation available to you, and you'll be able to see the map. And it shows you which states you need to be licensed in and which states you don't. And in those states, yeah, you're more than welcome to. So with that, Mr. Kreider,
Wow, love
that's
it.
that's some great questions, right? That was
I
awesome.
love it.
That was awesome. So yeah, do we let's go ahead and let's wrap it up. Do we have any closing words, Mr. Kreider, Nick?
The volatility to stop, please. And I think that's the biggest factor. I go on rates are what they are, but all this chaotic stuff that's going on, I wish everything would settle down. We get more of an even keel on the economy. This is what it is. We're not going to have all these ups and downs of stock market goes up 8,000 points, goes down 8,000. Bonds go down 10 basis points, then all of a sudden it goes up 20 basis points, all within 3 days. It just doesn't make sense, right? Get some get that volatility out there. And they're always a little bit, but man, get that more. I think that will get more borrowers out there more of a feeling of, I know what's going forward, even if it's not right for them to get in the housing market, it may not be right, but I think the overall sentiment for everybody out there is like, man, this is too chaotic. I'm hoping that goes down. And thank everybody here for what you do. This is not the easiest industry to be in today, and you guys are there every day working. And I just want to know we're committed to being a great partner with you. You can always reach out to us. Someone's going to get back to you. We're here to help you get more market share, and we're hoping to do that.
Awesome. Nick, do you have any closing words, sir?
Yeah, I would just reiterate, leverage your non-QM products that are available to you. Target those self-employed borrowers, the real estate investors, borrowers with the higher jumbo and LTVs. That's the bread and butter of the non-QM stuff. So target those, reach out to your AEs. They're here to help. We appreciate all your business, and we look forward to doing more loans with you this year.
Awesome. Thank you for your time. Bye, everybody. We'll see you next time.
Thanks, everyone.